Yeah, the third quarter is looking quite a lot different to the second quarter. So it seems that we had a respite in the second quarter as there was a lot of demand for travel services from consumers and businesses. So this led growth stronger, surprised everyone to the upside, both in terms of GDP performance and the PMI. But what these numbers are telling us is this is faltered in the third quarter. You're looking at contraction. While the numbers came up slightly from the deeply negative signs that we saw in August, they're still in a sort of zone that's 0.3, 0.4% GDP contraction.
Yeah, so we're not pointing to any kind of real recovery then as yet, right?
Not yet, no. And you've got to be careful this time of year with the volatility of the data. You know, we're talking Europe, where August is a quiet month. So any volatility in the numbers, try to look through that, look at the quarter as a whole, and look at what the forward-looking indicators are saying, because they're pretty negative as well. Things like backlogs of work, you know, how many orders have companies got to deal with to support their growth going forward. That's falling at a rate that we've not seen since 2012 if you exclude the lockdowns during the pandemic. Orders overall continue to fall faster than output, which means less output momentum going forward. And finally, business expectations about the year ahead, they plummeted quite sharply, both in manufacturing and services.
Yeah, I mean, that manufacturing one for me, I think, is quite key to note. I mean, if you take a look even at the German data, that points to actually a 39 handle there still, 39.8, I think it was today versus that 39.1. I mean, you're still sitting in the doldrums there, and that's recessionary territory.
Very much so, and what we saw is France also following it down now as well. One thing that we've been looking for is, when's this going to turn around? And key to that will be the inventory cycle. Okay. So we're watching very carefully things like the stocks of finished goods index that tells us just how much stock inventory companies are holding in their warehouse to go to customers. They are trimming that at a huge rate still. It's very severe. So this is huge concern about the demand outlook. They don't want to hold stuff in their warehouses, running it as low as possible for cost considerations. No signs of that inventory cycle turning around yet. It could be well into next year that we see that turn around.
The impact, as you spoke about, that job cycle then being the one that has held quite resilient for a period of time, in fact, across Europe in some situations. If you have a strongish job market but demand continues to wane, surely the job market begins to suffer at some point too, which overall still is going to impact these numbers for some time.
Absolutely. It's the famous lagging indicator, the job market, right? And what we've seen, especially in Europe at the moment, is that there's this big overhang of backlogs of work accumulated during the pandemic, which has helped people like German automakers really sort of soften the blow of the recent weakening of demand. So they've been drawing on these backlogs of work. They've been regulating it quite cleverly so that they don't deplete them all very quickly and then have nothing to do. So they've been managing this flow of backlogs work, supporting growth, keeping the employment numbers there. But until you see those new order inflows pick up, it's just going to get worse and worse. You're going to deplete those, and then you're going to be laying off
staff. Can those pick up in a high interest rate environment?
Well, this is the thing. What's the outlook for that demand environment? They're hiking rates, and we've still got the lagged impact of that to come. That's why we're so worried about this outlook. I can see a Q3 downturn. I see no respite in Q4, and that the lagged impact of interest rates hitting through into 2024 could, certainly adds downside risk to what we're seeing in terms of a shallow recession.
So, I mean, this recovery is going to clearly take some time. Then the worry about stagflation comes into play, of course, predominantly here too. Do you see a continued push by central banks who are now perhaps on wait-and-see mode, is what it feels like for some, where they might indicate a few more hikes later on? How much pressure does that put on these numbers for future? Because you're saying then that the recovery on this doesn't look like it's likely even in the first quarter of next year.
No, everyone's data dependent, right? So the high frequency numbers, the timely data such as these, this is why we do it. This is why we compile these numbers. It really helps give a really insightful guide as to what's happening right now. So this is why, for example, the Spanish GDP data were overlooked. That's ancient history now. The speed with which things are moving. So we need to be looking at these very carefully, and things like the price indices. So we've already seen a couple of months now of input costs, that index turning around on the back of the higher energy prices. What's really interesting, I think what the central banks are going to be watching very carefully, is the prices charged. That's still coming down. And this is a symptom of just that lack of pricing power amid weak demand. Your costs may be rising, but you can't pass it on to customers like you could do even 6 months ago. So this is a big deflationary impact we've got coming through from the demand side. It's going to be really important to watch how that transpires as we go into next year.